Good morning, everybody. Gianni DePocia here, live with you for Benzinga. It is Thursday, June 26, 2025. A few days left in the second quarter and the month of June. And we are live here today to talk about navigating market volatility with Direxion's leveraged and inverse ETFs. And I am joined live by Sean Edwards. And we're going to be taking you through the whole lineup of Direxion's ETF suite of products to show you how you can capitalize on these wide price moves in the markets, because we know there's been a lot of volatility this year. And the beauty about all of these types of ETFs is that you can play both sides of the market. So we're going to talk about how these products work, as well as how you can position yourself to take advantage of these market moves. So let's go ahead and bring Sean on. Sean, how you doing?
Good. Good morning, Gianni, and everyone watching. Thank you guys for having me once again, and excited to talk through some of that volatility and ways that traders can play both sides of the market. So,
indeed, it's great to have you back on, and we know that there certainly is a lot to discuss. I know I have a few ETFs I want to discuss with you, because there's a lot of opportunities in this tape. You know, all these headlines that we've had this year, whether it's tariffs, geopolitical situations, central banks making funky moves across the world, opening up a lot of opportunities. So I'm looking forward to diving into this and learning more about how these work and how we can take advantage of that. So let's get into it.
oh, awesome. Well, perfect. So this is a slide. We kind of have to have it here. Not much there by way of just valuable information from a trading standpoint, but a lot of disclosure. So feel free to read and screenshot if you want, but we can move to the next slide. All right, awesome. So just for those who are unfamiliar with Direxion as a firm, so Direxion, we are a ETF issuer. So we are located in New York City. We have offices in New York, Milwaukee, Boston, and Hong Kong. I want to highlight that because we are a global firm. We have a presence internationally. If you look at this slide here, you'll see the growth of our assets for, dating back to 2020. Can't see that well, but 2008, you'll see when we first launched our leverage ETFs to where we are now. You see the growth has been tremendous by way of number of ETFs, but also assets under management. Right now, we're above 50 billion in assets under management, just to highlight just the impact that, traders, retail investors are having on a firm like Direxion. Those individuals who are proactively looking for ways to, again, generate alpha within their trading strategies, they look to Direxion to utilize our leveraged inverse ETFs, whether they're bullish or bearish, to take advantage of some of these short-term price swings that we're seeing in the market. Again, driven by volatility, as Gianni mentioned, they present opportunities. I always like to say opportunity is everywhere, and even more so when you're thinking about trading leverage and inverse ETFs. There's opportunities. We have right now over 100 leveraged and inverse ETFs. So again, a lot of opportunities for traders. We'll talk through some of the nuance in later slides, but really Direxion, we're a place or we're a firm that if you're thinking of ways to take advantage of short-term price swings in the market, from a daily standpoint, we may have an ETF for you. We can go to the next slide. All right, so what you'll see here, and just really what I want to simplify and drive home, is the leverage and inverse ETF landscape. Right now, there's a few firms that are offering leverage and inverse ETFs. Just want to highlight there's probably in excess of 250 leveraged and inverse ETFs that you can find. If you're looking at CNBC or whatever you look at for your financial news, you'll probably see some tickers floating across the screen. And you may hear the mention of leverage and inverse ETFs and the risk that are inherent with leverage and inverse ETFs. So different opinions. We'll talk through ways that you can manage that risk or approach trading leverage and inverse ETFs in later slides. But 112 billion in assets within the leverage and inverse ETF landscape. Primarily what you'll see across the bottom of this particular slide is that a lot of the assets are within 3x and 2x bull ETFs, leveraged ETFs. You'll see that we also, within the landscape, you have inverse 1x, inverse 2x, inverse 3x. So some of you may already be familiar with, trading leverage and inverse ETFs. But simply put, if you're bullish and you want to bet that there's going to be an upward price swing, you can utilize our 2x or 3x bull ETFs. If you're bearish, you can hedge utilizing our inverse 1x, 2x, or 3x inverse ETFs. And so this is the landscape. Just want to drive home the point. The majority of assets, as we all could imagine, they're within the bull 2x and 3x ETFs. And I just wanted to also highlight that the exposure that traders are looking for within the broad, equity market segment. So think S&P 500 or the NASDAQ 100. And then you can get even more granular and specific and focusing on industries like semiconductors and biotech. You can even look at single countries. So think China, Mexico, and even India within our product suite. So again, traders that are looking to take advantage of the volatility that we're seeing in the marketplace so far this year, we have quite a few options for you. And we can move on to the next slide. And now I'm just going to slow down a little bit in the next few slides to really just really educate and really drive home the point of how we should look at utilizing leveraged and inverse ETFs. So leveraged ETFs, leveraged and inverse ETFs, just simply put, they provide enhanced exposure to an underlying index or a stock on a daily basis. So if, again, you are a trader and you're looking for enhanced exposure on a particular index or an individual stock, you would look at utilizing leveraged or inverse ETFs. So again, if you're bullish, you can look at a bull fund that gives you enhanced exposure on an index or a stock. At Direxion, we provide a broad suite of bull funds that give you 200% exposure and even 300% exposure to the daily performance of a benchmark index. Again, that's on a daily basis. If you're holding any leverage ETF and you're expecting that 2x or 3x performance of that benchmark index, you're not going to get it. The investment objective for a leveraged ETF, in particular, our leverage and inverse ETFs, are to give you that enhanced exposure just for a single day. So you can't expect to have that stated exposure for periods longer than a day. And bear funds are the same. That's just inverse daily performance of a benchmark index or single stock. The benefit of using leverage and inverse ETFs are that you do not have to have dollar for dollar investments. So simply put, $1 invested will provide you 2x exposure if you're in a 2x fund, or $1 exposure will provide you $3 worth of exposure if you're in a 3x fund. And just really to talk about the structure of our funds, our leverage and inverse ETFs to provide that stated exposure. What we're simply doing, and you can go to our website. So if you are new to investing in leverage and inverse ETFs, particularly at Direxion, you can go to our website, type in any fund, let's say SPXL, for example. And if you go to the website, you'll see a daily fund holdings tab. And that daily fund holdings tab will let you know what we're actually using to give you that enhanced exposure. And what you'll see consistent with all of our funds is we're typically going to buy an ETF that replicates an index, and then we're going to also use a swap to give you that enhanced exposure. So an ETF and a swap, and in some cases, we'll buy a basket of stocks that replicate the index instead of the actual ETF. And then again, we're utilizing that swap to give you that enhanced exposure. So why would someone utilize leverage and inverse ETFs? Again, for that, enhanced exposure, 2x or 3x exposure, or even inverse exposure to a particular index or single stock. And again, just for a daily basis. And we can move on to the next slide. So again, we're talking leverage and inverse ETFs, the structure, just the different ways in which you can trade depending on your investment thesis, whether it's, broad U.S. equity specific or individual stock or country specific. But to really drive home the point of how to use leveraged inverse ETFs, I want to spend a few more minutes on this slide and the next few slides just to drive home the importance of the education when you're trading leveraged inverse ETFs. As we know, if you're getting 2x exposure or 3x exposure, that's a higher reward. So as we know, if we're getting a high reward, there's likely that there's more risk involved to get that reward. This slide, if you have an opportunity, screenshot it. It just drives home the point of how we should look at leveraged inverse ETFs and how compounding can work for or against you when you're trading leveraged inverse ETFs. So in this slide, just to simplify it, we're going to start with $100 today. And let's just say we invest in a 3x bull ETF. And let's just say the underlying index is the S&P 500. Just to keep it very, very simple. Let's say we invest $100 today and the index is up 5% today. Because we're in a 3x bull ETF, our exposure there is going to be 15%. So our return on the day will be 15%. So we'll end the day at 115 because the index increased 5% today. If we're in a 3x bull fund, 3 times 5 gets you 15. So we end the day at 115. So that's a great trade. We're happy, we're excited. And so let's just say we want to hold that position. Instead of closing out, we want to hold it until the next day. The last two rows just are two different scenarios. So again, the first day we're up. Let's just say the next day, the index rises 5% once again. So if the index rises 5% on day 2, if we started the day 2 at 115, and the index is up 5%, our ETF will be up 15% on the day. And so we'll end the day at $132.25 because the compounding in this case is working for you. So that 15% gain in day 2 is compounded on your days gain from day 1. So 15% of 115, that gets you $132.25. So again, in this scenario, the index rises 2 consecutive days, so compounding is working for you. Let's just say instead of the index rising on day 2, it falls 5%. So again, we start the day at 115, the index falls 5%, so we're at a loss of 15% on the day. So our ending day assets at day 2, if the index falls on the second day, 5%, and then the ETF falls 15%, we end the day at $97.75. So what we're seeing here is that in this case, compounding is working against us. Compounding with leveraged inverse ETFs can work for or against you. And so if you're trading any of our leveraged products, it's important, one, to understand the investment objective of the fund is to provide you enhanced exposure on a daily basis. If you're holding a position for periods longer than a day, this is why we say you should not expect to see that 2x performance or 3x performance for periods longer than a day. In this particular scenario, you're seeing that you can't use simple math if you're trading leveraged inverse ETFs. It's compounding. So you see after just this period of volatility where the market's up and then down the second day, you're below your original investment. And so we have to be mindful if we're trading leveraged inverse ETFs that you want to monitor your trade daily. The trend is your friend. We'll talk through that in a little more detail. And I think we may have a question.
We do. The question is there a master list of leveraged funds by index, country, sector, etc.?
Yes.
That's from Kay Campbell.
Yes, thanks, Kay Campbell. There is. If you go to www.direxion.com, Direxion spelled DIREXION.com. Thank you guys for putting that on the screen. We have a full list of all of our funds. So again, 100 or more funds, U.S. equities, sector specific, and we'll talk a little bit later in this presentation, even leverage and inverse single stock ETFs. So a master list on our website if you go to Direxion.com. And we can move on to the next slide, and happy to answer any additional questions as they come in. All right, so again, just driving home the point of the education here before we get into any particular leverage or inverse ETFs. If you're looking at this chart, we're going to keep it really simple. The trend is your friend. Gianni, you look at technicals all day.
Oh, yeah.
If you're trading any of our products, because again, you have enhanced exposure to the daily performance of the underlying index or individual stock, you want to make sure that the trend is in the direction that you intend. So if you're in a bull fund and you're holding any of our funds for periods longer than a day, you want to make sure the trend is to the upside because you're in a bull fund, so you're bullish. And if you're bearish, you want to make sure the trend's in a clear downtrend. This chart simply shows that if the trend is your friend and the trend is working in the direction that you intended, it's going to be a better trade for you. Let's simplify this really quickly. This is looking at, again, a hypothetical example of investing in a 3x bull fund. The benchmark index over that period's up 11.4%. If we're doing simple math, the index is up 11.4%. 11.4 times 3 gets you 34.2%. So that's the benchmark's cumulative return over that time period, again, in a 3x bull fund. If you look at the mahogany line there at the top of the screen, you see that the 3x bull ETF, if you were invested in during that time, your return will be 37.3%. So that's more than the benchmark's cumulative return over that time period. So again, just showing you that the trend is your friend. If you're investing in a 3x bull fund and the trend is clear like it is here on this screen, then your return could be in excess of the benchmark's return during that period. And then the same way, if you're in a 3x bear ETF, but the benchmark is in a clear uptrend, you'll be down just 28.7% in this example. So that's less than the 34.2% you would be down. So it's just showing you, once again, you're not down as much because the trend is clear. So if you are new to trading leveraged inverse ETFs, I'm just driving home this point. These are tools that should be used tactically. Tactical short-term trading tools. You have to monitor daily. There's added risk, so you have to really make sure you're monitoring the market. So whatever you're investing in, whether it's an index or an individual stock, you have to make sure you're monitoring those trades daily. You may find that, hey, this type of volatility is not good for your trading strategy, and this is probably not a good trade for you, and you may not like leveraged inverse ETFs. But I just want to drive home the point that if you're going to trade leveraged inverse ETFs, it requires a little more monitoring of your trade. And we can go to the next slide just to drive home this point even more. So once again, this slide is just showing you a non-directional market. In the previous slide, it showed you returns if the trend was clear. This is showing you the returns in a non-directional market. You'll look at the benchmark index return here over a period of 7 days. Again, if you're investing in a 3x bull fund, this is a hypothetical example. If the benchmark's up 2.4% over that time period, 2.4 times 3 is 7.2%. So that's what we would probably anticipate the return would be if we're investing in a 3x bull ETF during this time. But you'll see again on the mahogany line there, you're up just 6.3%. That's because of this whipsawing environment in this hypothetical example. So you're not up as much. You're not up in excess like we saw in the previous slide. You're up less because compounding. And you'll see in the same way in a 3x bear ETF, you're not down less than the benchmark's cumulative return. You're down more than what the cumulative return would be. You're down 8.6% over that time period. So again, driving home the point that if you're going to trade any of our leveraged inverse ETFs, the trend is your friend. I always like to simplify it. There's three market environments. You have an uptrend, you have a downtrend, and a sideways market. And if you're trading any of our leverage ETFs, out of those different market environments, there's only one where you're probably going to see you outperform. If you're in a bull fund, you're going to make money if the trend is clear. If the trend is in a clear downtrend, obviously you're not going to make money in that environment. And then also, like you see in this slide, if you're in a bull fund and the trend is choppy and sideways, that's not going to be a good trade for you either. So again, driving home the point, if you're trading leveraged inverse ETFs, you have to monitor your trades daily. This is what you may hear if you're looking at leveraged inverse ETFs referred to as decay, because the portfolio is rebalancing on a daily basis. You have to make sure you are aware. So again, tactical short-term trading tools, you have to monitor it daily. The trend is your friend. And we can move on to the next slide. So how are Direxion ETFs utilized? So most traders, and Gianni, I'm sure you'll deep dive into this, again, use technical indicators and trade leverage ETFs to magnify their returns. So opportunistic trading. So if you're trading around earnings, volatility, tariffs, you can have various reasons that you want to trade leverage inverse ETFs, but ultimately you're looking to get enhanced returns. You're looking for an opportunity to express conviction and have enhanced returns. Also hedging. I'll talk through some use cases there within our single stocks in a few slides. If you have concentrated positions in, particular stocks and you want to hedge your portfolio, you can look at inverse single stock ETFs, or broadly speaking, if you're looking to hedge against downward price movements in the broad US equities, you can look at trading our inverse 2X and 3X ETFs. And again, for volatility, if you're looking to trade volatility in general, as we know, the market's been extremely volatile this year. Just an antidote, just to share with you all, when the tariffs were announced, we saw assets outflow, a lot of uncertainty in the market. So we saw our assets, drop quite a bit. But Liberation Day, we jokingly term it, right? But we saw assets flow into our suite after announcement was made that the tariff pause would be enacted for 90 days. So we saw, in particular, within our semiconductor 3X Bull ETF, we saw a complete turnover. That fund is a $8 billion fund. So on that announcement alone, we saw a complete turnover of that fund. So $8 billion within SOXL being traded on news. So again, volatility, trading around macro level environments. So a lot of opportunities to trade leverage and inverse ETFs. And talking through some of our inflows a little bit more, the top 10 inflows year to date within our product suite have been within our leverage and inverse single stock ETFs. So names like Tesla, Apple, Palantir, and even Alphabet, Google. So the top 10 inflows year to date for Direxion, out of the top 10 for our leverage and inverse single stock ETFs. Also, our 3X semiconductor ETF that I just mentioned, SOXL and SOXS, they're both in the top 10 inflows so far year to date. So our Bull 3X ETF and also our Bear 3X ETF for reasons I alluded to a little bit earlier. And then also, if you think about Yang and Dust, Yang giving you exposure to China, and then Dust, our gold miners ETF. That's in the top 10 in terms of inflows year to date as well. And that's because traders are looking for a contrarian trade. China in particular has been up year to date. It's led markets. If you're looking at opportunities outside of the US, China's performed pretty well. And then if you're looking at gold in particular, again, Dust is a gold miner's exposure, but that's been up year to date as well. So we have some traders that are contrarian that are looking to trade those as well. So inflows there. But then also, if we look at our outflows year to date, within that suite, the top 10 outflows from our product suite, all of those names have been bull funds. So you may ask why that is. That's, again, those outflows are a result of traders looking to take profits. So names like Yin, Chow, and CWeb, again, giving you exposure to the Chinese equity markets. Those traders that have been up year to date, they're looking to take profits off of the table. So again, just want to highlight ways in which Direxion ETFs are being used, macro level, macro environments, volatility, hedging, technical indicators. So traders are utilizing a few different tools to trade leveraged and inverse ETFs. And we can go to the next slide. So again, I mentioned a little bit earlier, just our leveraged and inverse single stock ETFs in the next few slides. I'm just going to highlight our leveraged and inverse single stock ETFs. So what you'll see is we right now have 20 leveraged and inverse single stock ETFs. So on this side, in the next slide, you'll see our lineup of leveraged and inverse single stock ETFs. We started back in 2023. We launched leveraged and inverse single stock ETFs on the Magnificent Seven. So that's Tesla, that's Amazon, Nvidia, Alphabet, Microsoft, Apple, and Meta. So if you're a trader and you're looking to trade the short-term price swings of individual stocks like the Mag 7, you can look at utilizing our Bull 2X ETFs that allow you to have enhanced exposure to the short-term price swings of those individual names. And as I mentioned a little bit earlier, if you're looking to hedge the short-term or hedge your position in those names, you can look at our inverse single stock ETFs. Again, we initially launched 7 within this suite, but we expanded. So we'll see, what you'll see is we launched additional leveraged inverse single stock ETFs on the larger semiconductor names. So think Micron, Taiwan Semiconductors, AMD, already mentioned Nvidia. So if you're looking to trade short-term price swings of those names, you can look at leveraged single stock ETFs, and those tickers are there on the screen. If you look at that third column there, that's the ticker symbol if you're bullish. So if you're bullish and you want to trade the short-term price swings of those individual names, you can trade those tickers there. If you're bearish, you could trade those names represented there in that fourth column. As you could imagine, our largest leveraged and inverse single stock ETF is TSLL. So that provides 2x daily exposure to the performance of Tesla. We know Elon Musk, he moves markets. Whether bullish or bearish, you have an opportunity to trade Tesla. So that is one of our largest leveraged and inverse single stock ETFs. I think right now it's around $6 billion in assets under management. But again, these are tactical short-term trading tools allowing you to get exposure to individual stocks in this case. We can move on to the next slide just to finish rounding out the suite of leveraged and inverse single stock ETFs that we currently provide exposure to. So again, names like Berkshire Hathaway, Palantir, Eli Lilly, Boeing, ExxonMobil. We also launched recently leveraged and inverse single stock ETFs on Cisco. So again, if you're looking to trade short-term price swings and individual names, you can look at the tickers here represented. If you are looking to get in touch with Direxion, again, you can go to our website. You go to Direxion.com, and we have a resource center where you can learn a little bit more about our tools. We have an education center, which you'll see on the next slide, that you can access as well. And if you want to get in touch, you can get in touch by going to our website, or you can email info@direxion.com if there's a particular question. But what I would say is start here at the Leveraged and Inverse ETF Education Center. We have a plethora of articles. We have a frequently asked questions center. We have video series that you can view. But what we also have is a Direxion ETF University. And I want to highlight that because it allows you to test your knowledge. So you'll go through a course similar to like college. You'll go through a course, and then you'll be able to test out your understanding of the concept of leveraged and inverse ETFs prior to trading, if you're new to trading in leveraged and inverse ETFs. So the Direxion ETF University is a useful tool to get started. But I'll stop there. Gianni, happy to talk a little bit further about any of our other stocks or leveraged and inverse ETFs. I'm sorry, but then also any additional questions that anyone may have. Happy to point you in the right direction.
Yeah, there were a couple questions in the chat. One of them that I thought you might want to answer is from Rhett. If TZA, which is the Russell 2000 small cap leveraged ETF, if it keeps going lower, is a reverse split going to happen soon?
Sure, no, and thank you for that question, Rhett. So for all of our ETFs, there are times, and just for everyone else who may not be familiar with how reverse splits take place within our leveraged and inverse ETFs, there are times where the price may be Sorry, guys. Means I'm here for a while. But there are times where our leverage inverse ETFs, in the case of TZA, if the price is at a certain point, we may enact a reverse split or a forward split if the stock is at a higher price. No announcements. If you want to stay up to date of any potential corporate actions such as the reverse split RET and everyone else, sign up for alerts on our website. There's again ways that you could stay in tune with what we're doing with all of our funds. So again, if you go to Direxion.com and you subscribe to alerts, you could be notified of any potential corporate action, such as a reverse split or a forward split. But Rhett, thank you for that question.
And then the last question before I get into my line up here is from Kay Campbell. Is your actively managed tactical ETF premised on a bull or bear market, and how is it different from just an equity index ETF?
Sure, and thank you for that question, Kay Campbell. So HCMT, that's a little bit different than our traditional leveraged and inverse ETFs. Our traditional leveraged and inverse ETFs, they track an individual index or an individual stock. HCMT, that's our actively managed ETF. So positioning there, if you are interested in trading in leveraged and inverse ETFs, but you don't necessarily have the experience to trade leveraged and inverse ETFs, you can look at HCMT. We partner with a sub-advisor. They are using their rules-based methodology to determine when will be in or out leverage ETFs within that particular fund. But ultimately, it takes advantage of a bull market. So you have enhanced exposure in this case, Kay Campbell. So, and feel free to reach out to Direxion after for additional deep dive within HCMT. But I don't want to get too far away just because I know you'll have additional questions. So feel free to, reach out at info@direxion.com. But premised on a bull market, great opportunity for those who want exposure to leverage, but are going to, defer to someone who has a track record of trading leverage and inverse ETFs. So hopefully that answers the question. Happy to, talk through it a little bit more, but maybe a little bit later.
Fantastic. Well, Sean, you ready to get into what I got for you today?
Yes, absolutely.
Like I said, there's a lot of things, a lot of exciting things happening in this market. And what gets me the most excited is that, what happened into that April 7th low, based on, the tools and techniques that I use, was basically a major market reset. And coming out of these type of market resets really give you the best opportunity to make good money if you know where to look. So today I want to take our viewers through some of the tools that I like to use and that I have compiled over the last 14 years of my trading journey. You mentioned the semiconductor index. Let's start there because chips, really, there is no technological revolution. There is no AI. There is no quantum computing. There is none of this cool stuff that's changing the way we operate on a daily basis without semiconductors. And so what I have here is the Philadelphia Semiconductor Index chart. Now, this is not a Direxion ETF, obviously, but it is one of the indices that the ETFs follow. And so, there's a few things to review here, and when you are trading based on the charts, there are multiple techniques that you can use. But let's start off with just something very simple, something that Sean mentioned earlier, trend following. Okay, so what is the trend on this chart? We're looking at this daily chart going back a little bit less than a year. So you can see how the semiconductor index had a pretty rough start to 2025. You had that lower high in February, and then you took out this low from January. You were making lower lows and lower highs, a very clear downtrend. Now, if you want to add another layer, you could say this was a price pattern, otherwise known as a rounding top formation. You broke below that. I'll talk about support and resistance in a moment as well, another very important tool. But what we saw out of this low in April is known as a V bottom. I mean, semiconductors have been on an absolute tear and up, over 60% from that low. And this is just the index. This isn't the triple leveraged bull side, semiconductor fund. This is just the index itself, which is really, really amazing. And all of these charts, by the way, are as of yesterday's close. So now you're making higher highs and higher lows. And, the real big turning point is when you took out this high from March earlier this year. Why? Because that was the previous lower high. So basically ever since, mid-May, if you were just following simple trends, you had an idea that the trend was turning back higher in semiconductors. So one of the ways to take advantage of that is with SOXL, Direxion's Semiconductor Bull 3X shares. And, one of the things I like is that you see these patterns, you see these trends, you see these support and resistance zones play out on these charts so much. So, you can see that going into that April low, a very clear downtrend in the bullish fund. Not surprising given the index was very weak. But then we started to turn a corner. Now, I do want to take a moment to talk about support and resistance. Now, support and resistance are simply lines or ranges on charts. Okay, these are zones where there is a mismatch between supply and demand. Okay, so let's take it back to Econ 101. What is support? Support is simply an area where demand exceeds supply. Resistance, on the other hand, would be an area where supply exceeds demand. And so you can see here that when SOXL dropped into this, $17, $21 range back in March, you did get a little bit of a bounce, okay? Because initially there was some more demand than supply, but that didn't last. And what that told us was that supply exceeded demand and it brought prices back down lower. Now, perhaps one of the most important rules when it comes to support and resistance is that when support breaks, it becomes resistance, and when resistance breaks, it becomes support. So look at what happened to the prices when you rallied back up into this zone back in May. The rally slowed down. It was a pretty strong rally between early April and mid-May, but then it stopped for a couple of weeks. Why? Because you had entered a resistance zone. Now, if you combine support and resistance with trend studies, you start to paint a more clear picture. Because what happened? Okay, yes, you rallied up into mid-May, but it was still a lower high compared to late March. So you could say, well, the trend is still down. But here was the clue. When you dropped back down lower, you formed a higher low compared to April. That was the first sign that the trend was starting to change. And then eventually you broke above this resistance zone. It was formerly support, and you've since continued higher. Now, for the chart pattern fans out there, and I would definitely include myself in that category, you do have an inverse head and shoulders pattern on this chart, and we've broken above that neckline that overlapped with that resistance zone. So to me, it looks like the trend is turning higher on semiconductors, and I would be focused on the long side. Now, what could go wrong? Because this is a big part of being a trader. Always having a plan B, always having a contingency plan. The most dangerous thing in trading is to have conviction without a backup plan, okay? So we know that chips are especially sensitive to tariffs. They're especially sensitive to trade deals. Sean mentioned the 90-day pause, back in April. Well, guess what, guys? We're coming up on that 90 days. There were some, little extensions that were granted. Basically, end of July, early August could be a dangerous time if no further deals are made. And in that situation, you could actually see a rebound in the Direxion Semiconductor Bear 3X ETF. You can see how it's been absolutely hammered. Not really surprising given what has transpired in the semiconductor index itself. So if we start to see rumblings of tariffs coming back into effect or trade deals falling through, I would keep my eye on this SOXS fund, because that could be a way for you to play that headline risk. All right, let's switch gears here and talk about China. Okay, so it's really amazing when we just sit back and look at how stock markets have performed over the last decade, last several years, because it's been one that has been absolutely dominated by the U.S. market. U.S. shares have been outperforming their international peers by a very wide margin. But year to date, that has not been the case. As a matter of fact, It's not China, but the best performing stock market year to date now is Greece. Up until last week, it was Poland. Okay, Direxion has funds you can trade in the emerging market space, trade in developed market spaces internationally. But I especially have my sights set on China. Why? Because I think the DeepSeek release back in late January really changed the game, and it made China a serious contender in the AI arms race and the futuristic technology pursuits. And so, there are some decent things happening here. And keep in mind that, China has been one of the more aggressive countries when it comes to stimulus, trying to get their market moving. They never stopped, even as, the Fed was raising interest rates, a few years back. China never really stopped with their stimulus. And so we could start to see that paying dividends. But just real quick here, I want to review some of the principles that I mentioned on the previous slides. You can see here how there was a support zone. You saw prices bounce off of this, this range here back in January and then back in April, once again highlighting the importance of that technical zone. And, you can just eyeball this. It does take training. It does take practice. But with time, you will start to see where prices have a tendency to congest or start chopping around. Like Sean said, not every trend is up. Not every trend is down. Don't be the trader to get chopped up in the chop. It's a very tough environment to trade in. Look for those clean trending markets. And it looks like in China, the trend is starting to turn up. Yes, you had this low here back in April, but what did it do compared to the U.S. market? Well, if you recall, the U.S. market, when we sold off into that April low, actually erased all of its gains from 2024. That's right. We full round tripped everything, but not China. China stayed above its January low, because this is the FTSE China 50 index. Okay, we stayed above that January low, formed a higher low, and off of that bottom, we've been forming higher highs and higher lows. I especially have my eye on this low from early June. That was a significant higher low. And then you took out this high for May in June, and now you just made another new high. So to top that off, you have this price pattern here that's called an ascending triangle pattern. These are especially important within the context of this uptrend. Why? Because triangles are known to be what's called continuation patterns. Continuation of what? Continuation of the trend. Okay? So this is how you can use trend following, support and resistance, knowledge of patterns to see what a more probabilistic outcome could be, because it's all probabilities, right? Like these patterns can and do fail. There can and do fail. Then, if you want to get into some more advanced charting techniques, that's a conversation for another time. But this looks like we could be on the precipice or the verge of a resolution higher. So how do we play this? How could we play this? Well, you have yin, which is the China Bull 3X shares. Same pattern. What do you have? Okay. Higher highs and higher lows. It's interesting how you actually took out this low from January and April, but that's why Sean took some time to explain which can amplify moves in different directions. Always be aware of what the index is. What is the benchmark that these ETFs are tracking before you trade them? Take a look at them. Take a look at them, because the leverage is an amplifier. It amplifies your reward. It amplifies your risk. And it also amplifies the technical moves on these charts. Okay, so here we have higher highs and higher lows, the same triangle pattern. We're pressing up against resistance. If it breaks, look out above. But what if the tariff news comes back? What if geopolitical tensions escalate over in Asia? What if we can't make a trade deal with China? Well, similar to the bearish semiconductor story, there's an opportunity to take advantage of the bad news, and that's through Yang, the China Bear 3X shares. Here you have a downward sloping trend line. Now, I am not one of those traders that believes a trend changes when a trend line is broken, because, the points or the extreme highs or the extreme lows that you connect are somewhat arbitrary. I'm more of a fan about horizontal levels of support or resistance being broken than sloping or diagonal ones. Okay. But when you do break these sloping trend lines, it does tell you that the rate of descent or the rate of ascent, if it's sloping upward, is no longer in effect. So right now, the momentum's on the downside in Yang. The Chinese market is doing well. But we start to get some bad news creep back into the tape. Look for this to break above that trend line, and then it's going to change the whole dynamic of the bullish story, and you might be looking at some more bearish opportunities over in China. All right, how about bonds? How about bonds? What is the Fed to do? What is Jerome Powell going to do here? Well, he's been talking some tough talk on the inflation front, saying that tariffs are going to be inflationary. We haven't seen that quite yet. It hasn't showed up in the data. We did have the big spike in energy prices due to the geopolitical events over the last couple of weeks, but bonds actually held up pretty well. We're looking at long-term treasuries here, okay, and this is actually the long-term treasury bull 3x share. So we're basically tracking 20 treasury bonds of 20 years or more. Long-term treasuries tend to be even more highly sensitive to changes in inflation expectations. So if you're looking to trade bonds and you want some wider price swings, you look on the long end, the ones with a longer maturity. So what we have here is we've seen it trend lower over, the last couple of months. We had that high in April, then we had that blow up with the whole Liberation Day thing. We formed a bottom in May, and we've been trying to climb back higher. We broke out of this pattern called a falling wedge, but has the trend actually changed on this? Not yet. Not yet. It's been a tricky market to trade because you did make a new low here in May compared to April, and you've not made a significant higher high yet. These falling wedge patterns, however, can open the door for reversals back higher. So we'll see if this upward momentum that we've had over the past month can continue. If not, if the Fed's going to be stubborn, if we're not going to see interest rates fall, if we're going to see inflation start to make a comeback, if trade deals don't go through, then you might have some opportunities in TMV, the long-term treasury bear 3x. You actually have this beautiful cup and handle pattern forming on this chart in the event that bonds eventually do break down. But we're not really ready to break out from this pattern just yet. So this isn't a pattern that I would be ready to trade on at the moment. Now, if we were to clear this upper horizontal trend line here, acting as technical resistance, then I'd be a bond bear. But until then, I'm really just standing aside in this market because it is a choppy one indeed. All right, we did have a question in chat about gold miners. So let's take a look at the gold mining index. This is the New York Stock Exchange ARCA Gold Miners Index. Gold's been one of the best performing markets year to date, outperforming stocks, outperforming crypto for now, for example, outperforming bonds. But could that be on the verge of changing? The first half of this year was one filled with volatility, filled with concerns, filled with uncertainty, an excellent environment for gold. And we're looking at gold miners here, just to be clear. But gold miners, they tend to do better when the price of gold is up, right? They're mining gold. If the price of their product is increasing when they sell it, that means higher bottom lines, more revenue, more earnings, okay? So here too, very clean uptrend, higher highs and higher lows. Trend is your friend. We have an ascending triangle pattern like we saw before. Will this resolve to the upside? Well, I do think there are some downside risks in gold, but I do think there will be a big dip buying opportunity at some point this summer. Could we come back down to test this lower trend line? That's certainly a possibility. Or do we come back down lower and test some of these horizontal levels of support, like where my laser is here? So we need to be ready for either outcome here. In the event that we see the bullish resolution to the upside, you have the Gold Miners Index Bull 2X shares. I like to call it Nugget, NUGT, okay, like a gold nugget. Higher highs and higher lows, very clean uptrend, and you have the triangle that leaves the door open for a continuation to the upside. But what if we have good news this summer? What if trade deals get struck? What if the Fed starts to lower interest rates? What if we get tax cuts? What if things actually end up being okay? I know that's not really popular in the age of doom and gloom on the internet, but hey, in trading, we like to follow what the price action is telling us. In that situation, you could actually have Dust, which is the Direxion Gold Miners Bear 2X fund, catch a bid. That would mean that gold's probably dropping and gold miners are following with it. There's an opportunity to take advantage of that on the downside through Dust. If we break this downward sloping trend line, we could see this pop back up to test this high from May. If it gets really bad, you might even test that high of April, but let's take it one step at a time. Let's take it one step at a time. All right, let's talk about some of these individual stock names. It's amazing when it just like the way that the trading landscape has changed, even in my career. When I started, it was T+3. What does that mean? How does it matter to you? Well, when you would buy an ETF or a stock, you had to wait 3 days for that transaction to settle. Not really the ideal environment to be trading leveraged ETFs, which require, daily monitoring and sometimes in and out of a position same day or the next day. Well, now when you buy a stock or you buy an ETF, and these leveraged funds are treated the same way, the transaction settles the next day. It used to be if you wanted to put leverage into your portfolio, you would have to go to the options market, you would have to go to the futures market, you would have to apply for margin in your trading account. Now Direxion's doing the job for you, which is pretty cool. And the industry has evolved to where you won't be punished for making these quick trades. And I think it's a good thing because it adds more liquidity to the market. The more people that are trading, the more volume there is, and the easier it is to get fills on your orders. So let's start off by talking about arguably the most important stock in the entire market, which I don't know, it's up for debate. Is it Apple or is it Nvidia now? We're going to look at Nvidia too, but let's start with Apple. Apple's had a rough year so far, okay? Very clear downtrend, lower lows and lower highs. And you can see here how there was this support zone. We broke below that. It came back up, and it's held as resistance. Okay, Apple has really struggled to get back above 200, 210. But you're trading in that now. Here's the catch, though. You have what's called the symmetrical triangle pattern. Now, this is a downtrend, right? You could argue that we're starting to change that downtrend because you can see some higher lows here compared to April, but we haven't really seen a meaningful higher high yet. Now, these triangles are usually, like their siblings in the ascending triangle, continuation patterns. But in order to be bullish on Apple, we would have to get back above 210. Otherwise, there are still some serious downside risks. If you want to bet on the bullish side, probably a big catalyst for that would be some sort of good news with China. I mean, this is a company heavily reliant on manufacturing over in China and whatnot. So you want to look for a good outcome above 210. Maybe we do get a good trade deal. Below 200, though, AAPD might have the best opportunity to be on the short side of Apple. Now let's talk about some semiconductor names. So I started off discussing the importance of the semiconductor, and one of the characteristics that we see with markets that have just completed important bottoms is a leadership of semiconductors and technology out of the low. And that's exactly what we've seen since April 7th. And this is particularly exciting because Advanced Micro Devices, blue chip semiconductor name, been around for decades, has really been hit hard over the last, year and a half or so. But not since April 7th. It's been on an absolute tear. The trend has absolutely turned. Look at how we were trending lower into April, okay? Then you had a powerful rally out of that April low. You took out the high from March. You took out the high from February. That was a big step in the direction of the bull trend. To take it a step further, you broke out from what's called a broadening bottom. I like to call these momentum patterns because they are notorious for seeing prices accelerate to the upside. And indeed, we have seen AMD accelerate to the upside. Now, look at how it reacted in this resistance zone here. It went sideways. It spent about 2 weeks, 3 weeks just chopping around. As a rule, a market that goes sideways near the highs of a move is displaying bullish price action. Okay, so if you like the bullish case, you think it's going to continue to the upside on AMD, you can double up on that upside move with AMUU. But if you think we're exhausted and we're due for a little bit of profit taking, AMDD could provide you some hedges. That's the nice thing about some of these these ETFs too, these single stock ETFs. If you own any of these stocks outright and you don't want to hedge through options, say you don't have options, capabilities on your account, you can hedge through some of these inverse ETFs as well. Okay, Broadcom, another big semiconductor name. We have a similar pattern here, same pattern, broadening wedge, higher highs and higher lows. You know, the list keeps getting longer and longer. How about Nvidia? Huge breakout over the last few days. Aside from Apple, arguably the most important stock in this market. Has any other company driven the AI revolution like Nvidia has? It's at new all-time highs. I wouldn't call that exactly bearish. Plus, we have an uptrend of higher highs and higher lows. So this is a big move. If you want to double up, if you want to really get aggressive on the bullish side, NVDU, Bull 2X Nvidia Fund, or if you think that the tech party is coming to an end, NVDD can provide some opportunity to protect yourself for some downside. How about Google? Google has lagged. Google. I'm always going to call it Google. It's like X. I'm always going to call it Twitter. Alphabet is the proper name. The ticker symbol is still Google, so that's part of the reason why I still call it. But this one's been a bit of a laggard, kind of like in the same category as Apple. You have this resistance zone here, a lot of choppiness in that 170, 180 range. You're hanging out there right now. You clear 180, Google or Alphabet could eventually join the party. You might be interested in GGLL, the Bull 2X Alphabet Fund. But if the downtrend stays intact that we've had since the start of the year, you could make some money with GGLS. How about Tesla? Sean mentioned how Mr. Elon Musk does move the markets. Okay, fine, sure. But I think that the guy who is making robots that are going to manufacture his cars with, a self-sufficient energy source might have something going for him on the fundamental side of the equation. But it has been in a downtrend since December. Is it trying to flip that trend in favor of the bulls? It's certainly a possibility with this higher low in June. But I would want to see this high from late May taken out to the upside. If it does, you have that same setup that we do in Alphabet here with this rounding bottom. It could start turning very bullish. Palantir has been one of the hottest stocks in the market. Just to highlight and showcase the bullishness of this stock, it has doubled since that April 7th low. So these are large cap tech names, guys. Don't let anyone lead you to believe that you need to trade these penny stocks or take on a bunch of leverage, to have nice moves. Direxion's doing a lot of that leverage risk management for you. And so if you want to continue betting on the upside for Palantir, PLTU, the Bull 2X fund could provide some more opportunities. But again, you're not going to be wanting to hold this, for 2 months, like as this move has moved out. So if I'm trading the PLTU, I'm watching for a break of this resistance of this cup and handle, and I'm looking for these multi-day pops on those upswings. Last and certainly not least, we have Netflix. The streaming wars continue. This has been one of the strongest stocks in the market. Not technically a Mag 7 name. It was one of those good old-fashioned FANG names, but that acronym fell out of favor, I suppose. But it has been a very powerful one, and it has started to rally within what's called a channel. So this is one of those patterns that if you start to see a stock climbing in the channel, and it's already in an uptrend, it's more likely to continue. So NFXL looks like the trade here. But if you think it's starting to top out, NFXS. So just to summarize everything I went through, I know I threw a lot at you, but we're running out of time here, so I want to make sure that we can answer any final questions. You cannot afford to stay wrong for long when you're trading with leverage. Sean showed you the numbers. He showed you the data. You need to have a plan. You need to have your risk management defined. How much are you willing to lose if you're wrong? When are you ready to exit when you are right? How much money are you willing to put on the line? Okay. It's all about risk reward. My break-even rate as a trader is 25%. I only need to be right 25% of the time to not lose money. I'll take those odds to the bank all day, every day. If you want to stay connected, you can find me on X or Twitter at Gianni_Depoche. And I think we do have a couple of questions here if we want to cover them. Oh, here's a good one. Are these optionable? Can you trade options on these ETFs, Sean?
So some of them are optionable. We don't manage the options trading on those funds, so connect with your broker just to see if any of our funds are optionable. But some of our larger traded funds, they are optionable.
Okay. And actually, that's the only question we have. So, Sean, any final words? Thanks for this great session. It's always a pleasure.
No, I was going to say thank you for also just further driving home the point of just, monitoring trades daily, in some cases intraday, depending on the volatility.
Absolutely.
This year's been volatile. We have ETFs, whatever the opportunity is that you're looking to trade. So definitely check out Direxion.com. And thank you again for having me, Gianni.
All right, Sean, always a pleasure. And we'll be looking forward to having you back on again. Everyone, thank you so much for joining me as we discussed how to navigate this market volatility with Direxion's leveraged and inverse ETFs. It's amazing the type of innovation that we have and the opportunities that we have to trade nowadays. The barriers to entry into the trading world have never been lower. It's never been easier to access markets, but don't let that access lead you into a bad place. Leverage the educational resources at your disposal. Always do your due diligence. And remember, this is speculation. It's not gambling. Big difference. Know the difference between the two. And thanks again for tuning in. Gianni Depoche signing off. We'll catch you next time. Take care.